Stock markets continue to fall throughout the day. We're close to market close now. We're speaking with Jeff Christian, managing partner of the CPM Group, and Jeff will be talking to us about why the markets are falling today and his outlook for the broader economy as a whole. Jeff, welcome back.
Hi, it's good to be back.
Now, Treasury Secretary Yellen made a statement today that some would say spooked the markets. I'm just going to read her statement and then we can comment on that together. It may be that interest rates will have to rise somewhat to make sure that our economy doesn't overheat. She was talking at an economic event earlier this morning. Now, Jeff, first of all, how are you interpreting this message? And second, did it have any substantial impact on the markets today? In other words, did the market slide because of her statement or because of something else?
Well, I think that Secretary Yellen was speaking the truth, and she was trying to get that message out to people to sort of help them understand that as we move forward as an economy, there will be a time when interest rates will rise, and investors and others ought not to panic if they see a modest increase in interest rates. So I think that was her message. That was my interpretation of it. And that falls in line with what the Treasury, the Fed, mainstream economists, CPM Group, and others have been saying that they see in the real economy in the United States. Obviously, it had a major effect across markets in that people said, okay, so the Fed will allow interest rates to rise. And the big question is, what's a moderate increase?
Right. Before we talk about the economy, I'm just curious. We know that Yellen was the previous Fed chair, but she is no longer. Why is she still commenting on monetary policy, and why does her message about monetary policy still carry weight in investors' eyes? In other words, why is it moving the markets? She's working for the Treasury now.
Well, I think there are two reasons. First off, she's the Secretary of the Treasury, and the U.S. Treasury is the Fed's primary client. The Fed is the bank for the Treasury. So the Secretary of Treasury has an enormous amount of policy related to monetary policy. And the Fed is the entity that borrows the assets, issues the bonds. You're not seeing Fed bonds, you're seeing Treasury bonds that are being sold to finance the deficits. And the deficits are, well, they exploded last year. They exploded over the last 4 years. They got really problematic last year, and they're going to continue to be problematic for the foreseeable future. So the Treasury has an enormous role to play. In addition to that, I first knew her when she was the head of the Congressional Budget Office, which is the nonpartisan economic research think tank that advises the Congress as to what it thinks the administration's policies will do economically. And she's always been an incredibly good and highly respected economist. Some people will argue she is a much better economist than she was a Fed chairman. But, setting that aside, her understanding of the economy and of the monetary and fiscal policies and their effects on the economy are incredibly good. And she knows a lot more than most other people about it. So when she speaks, we all owe it to ourselves to A, listen, and B, try to understand what she's saying. But the real reason is she's the Secretary of the Treasury.
Mm-hmm. Understandable. Do you find her message contradictory to Jerome Powell's stance on inflation? Jay Powell has repeatedly said over the last few weeks to months that he thinks that inflation is transitory and that it is not persistent. He did indicate that, of course, if inflation runs hotter than 2%, the Federal Reserve will be prepared and has the tools to bring it down. But he did not indicate that he is ready to raise rates. So I wonder if there's some sort of conflict in the message here.
I don't think there's a conflict. If there's a difference, it might be in terms of timing, in terms of the forecast horizon that they're looking at. The reality is that inflation is not problematic. Insofar as the Fed and the Treasury would like to see 2% real or 2% inflation in the United States. And I don't necessarily agree with that policy, but that is their policy, and it has been for a long, long time. They can't get inflation to 2%. So there are pockets of volatility. And you see people saying, oh my God, look at these, massive price increases in individual types of foods. And what you're seeing is that, you have some supply disruptions, you have distribution disruptions, you have increases in demand, A, because people are a little bit better off financially, and B, because they have a lot of pent up money because they've been locked down at home for the last 12 months. So you see pockets of strength which show up in short-term blips in inflation. And Powell has talked about that. Yellen has talked about it. CPM Group has talked about it. That's there. There's a broader inflation, which is where that monetary accommodation is going. And that inflation is in the stock market, in the bond market, and increasingly in the housing market, because of the housing market has become financialized. Investors, you're seeing people buy houses and drive the price up. But if you look at who's buying the houses, some of them are actual residents or future residents of those houses, but there's a tremendous amount of investors buying houses on spec as if they were stocks or bonds. So you're seeing inflationary factors there, and then that spills over into lumber because you use the lumber to build the houses and stuff like that. But I don't think there's a contradiction. I think everybody that's looking at the data carefully is saying, okay, problematic inflation is unlikely. We could have spurts up in inflation because of supply disruptions, supply chain issues, distribution issues, and spurts in demand for various goods and services. But inflation is probably not a problem. However, we have poured trillions of dollars of money into the economy. We are now coming out of the recession. And so you do have to pay attention. William McChesney Martin, who was probably the best Fed chairman ever from 1950 to 1971, I believe, a St. Louis resident, I should point out. William McChesney Martin is accredited with saying that the Fed's job is to lean into the breeze of inflation. So you don't worry about inflation when it's a strong wind. You worry about it when there are signs of it. And I think that what Yellen was talking about was we should expect some upward pressure on interest rates. Not to say that they're going to run away and get to 3 or 4 or 5% nominal anytime soon, but we should expect some increases in inflation or in interest rates because of all of the monetary accommodation and some of the other inflationary pressures. I think also what she was doing was she was sort of speaking to the panic, if you will, that you saw in March when interest rates got over 1% and went to 1.5 and 1.75. And there was a lot of speculation, at least in the gold market, maybe not in the broader macroeconomic community, but in the gold market, let's extrapolate this. This is going to be 3% by June. And I think that what she was doing was saying, look, there will be upward pressures on interest rates, but it's not the kind of thing you need to panic about the way some people panicked in the first 2-3 weeks of March.
Okay, you showed a slide in one of your recent slide decks. I'm going to show it here now. It's Inflation Details Matter is the name of this slide, and you broke down the CPI by components. What is the significance of showing this particular table now, Jeff? We can go over this together. We can see that as of March, the biggest gainers in terms of prices in the components will be gasoline, energy, utilities. Interestingly enough, used cars and trucks went up by 9.4%. So, food, people complain about food, but relatively small increase in prices for food overall. Yeah. So how are you reading this?
Yeah, it's very funny because some guy, complained that I was downplaying food inflation. He said food inflation was 13% in March. It was like, no, it was 3% or 3.5%, which is bad enough. There are various things to unpack from the March statistics. One is, first off, you always have to look at core inflation, excluding food and energy, as opposed to headline inflation, because food and energy tend to be very volatile. And last month, or in March rather, you saw extremely volatile oil prices, petroleum-based prices. So it was gasoline, it was heating oil, things that come from petroleum or things that are closely related to petroleum. And that was because petroleum was coming from a very low price. Remember, it got to negative numbers a year ago? Petroleum was coming from a very low price to a more historically typical price. So you saw these 20 22% increases in energy. And you had total CPI, headline CPI of 2.6%. But if you take out the volatile food and energy and you look at core inflation, it was 1.6%. It was in line with recent months. It's still below the Fed's target. So the Fed is still struggling to get inflation higher. They're not worried about inflation being too high. Used car sales, the prices of used cars shot up in March because with the semiconductor shortage, there's a shortage of new cars. People are buying new cars, people are buying cars because they're moving from the cities to the suburbs and exurbs. They need one car, they need two cars. They can't buy new cars, so they're turning to used cars. And used cars, because they don't have an auto industry behind them, it's a dealer on a lot. Used car prices have shot up because there's greater demand for used cars because you can't get new cars. That's probably going to go away in a month or two as the semiconductors thing gets in. Those are those kinds of short-term pockets of inflation that Powell and CPM Group and others have been talking about.
Okay, so you don't think that? All right. Well, let's assume that these prices stabilize and they reach equilibrium in a month or two, as you have suggested just now. What do you think is going to happen to monetary policy? I've heard rumors from various analysts that potentially tapering is on the agenda at the next meeting.
What is on the agenda?
Fed tapering.
Well, the Fed has been saying that it doesn't foresee tapering for an extended period of time. And I think the Fed probably knows better than whoever it is you're talking to or hearing that from.
So you don't think they're going to raise rates anytime soon? I mean, Yellen was hinting at it, but in actual practice, you don't think the Fed funds rate is going to remain at its current level for the foreseeable future?
Our expectation is that the 10-year T bond is probably going to trade between, say, 1.55 and maybe 1.8, maybe 1.85 over the next 5-6 months. There is going to be upward pressure on it. You have to understand that in the Treasury bond market, there are two sides to the market. There is the Treasury, which actually produces the bonds. The Fed markets it for them. And then there are the people who buy the bonds. And those people who buy Treasury bonds have a plethora of alternative assets they can buy. And one of the things that you saw in April was them pivoting back to Treasuries away from other sovereign bonds and corporate bonds. So that was one of the factors that took interest rates down. So looking forward, yeah, we think that there's upward pressure on Treasury bond interest rates, but those will be offset by some other factors, and we don't necessarily see it rising. We don't necessarily see it rising because the Fed or the Treasury wills it. Part of it is going to be the demand side of the Treasury bond market. Do these guys want more Treasury bonds, or are they starting to worry about having so much exposure to Treasury bonds because of the enormous issuances that we've seen?
It's not just Treasury bonds that central banks are buying now. It's like if you take a look at the Bank of Japan back in March, they purchased 50 billion yen worth of stocks in the form of ETFs. I wonder if that's on the agenda, or possibly on the agenda for the Federal Reserve. Could they do something similar?
Someday, maybe while I'm still alive, you could see that. I don't see it in the foreseeable future. There are a variety of reasons why the Fed, I think, would be extremely hesitant to do that in the United States that don't necessarily exist in Japan. And the Japanese financial market and economy are radically different from those of the United States. So I can see the Bank of Japan doing that, as we are seeing them do that, for a variety of reasons that don't necessarily apply in the United States.
Okay, so let's put all this together now and talk about your short-term, medium-term, and long-term forecasts for gold and silver, given your inflation outlook and the economic outlook.
Okay, well, starting with gold, we still think that the gold price is going to head higher at some point in the next 3 to 10 years. and that'll be related to another financial crisis and probably another recession. But we think that that's at least 2 years away, probably maybe coinciding or coming shortly after the next U.S. presidential election in 2024. It's hard to say. It's impossible to econometrically project the timing and depth and breadth of future recessions. But you can say, yeah, there's going to be one. And there's probably going to be financial crises, given all of the problems that the world is facing that aren't being resolved, and some of which are being compounded by monetary accommodation and rising sovereign debt and things like that. So in the short term, we think gold prices probably could show some weakness in the next 5 months. We're going into the summer doldrums. There's some seasonal weakness in fabrication demand. There's some seasonal weakness in investment demand. I wouldn't be surprised to see the gold price drop back towards 1650, 1655, 1670. And I also wouldn't be surprised to see the price go up to test 1800 again, and maybe even go as high as 1830. But I think that you're in this broad channel for the next few months. By the end of the year and into 2022, I think that you'll see gold prices moving more firmly above $1,780, $1,800. And then beyond 2022, we do think that you'll see gold prices rise much higher. Silver's a similar pattern. We think that the price could trade between, say, $23 and $30 between now and September. It could start moving more into a $28, $32 range toward the end of this year into 2022. And we do think that silver prices are going to rise to record levels at some point when we see that next spike. And I should point out, we saw record prices for gold last year, but we didn't see silver prices anywhere near record prices. So we do think that over the next 3 to 5 years, you will see silver prices outperform gold. Platinum and palladium, we like platinum. We're telling investors that if you're going to stock up on a PGM, platinum is probably the better one. Palladium is very top heavy. You've had some supply disruptions in Russia and in South Africa earlier. You have rising demand in the auto industry and electronics industry. You have industrial users building inventories because they're worried about the price and supply. And then you have a lot of investors pouring in. And those investors are the thing to watch out for, because if they stop buying or if they decide to take profits, the price could come back down. Yeah. We wouldn't be surprised to see a relatively significant 10%, 15% decline in palladium prices at some point. But I wouldn't bet against it, because right now palladium's a runaway trade. Platinum, 7 years of bear market. We're now seeing the price increase. We're seeing some shifting out of palladium into platinum in the auto industry. I think that platinum probably will be stronger than palladium going forward.
Okay, well, this is an interesting slide here. I'm going to show both of these. Real GDP, the first one showing annual percent change, and the second one is just a level in absolute terms. Now, explain to me the title for the second chart. In actual output terms, the U.S. remains in recession. You mentioned earlier that you were expecting another recession, but this chart is telling us that we're still in one. Explain what that means, Jeff.
Yeah, a recession is in place until actual economic output exceeds the level that it got to before the onset of the recession. And if you look at that second chart, you'll see that actual U.S. output in the first quarter was still below that where it was in the fourth quarter of 2019. So one of the reasons why you saw interest rates rising was there was a lot of optimism about the economic prospects and the onset of the vaccine, the arrival and distribution of the vaccine in March and April. And that caused investors to say, well, there's going to be upward pressure on interest rates, and they bid the prices of interest rates lower, driving interest rates higher. So what we were saying is, yeah, if you look at the percent change from a year ago, which was a recessionary period,
sure,
it looks really good. 6% real GDP growth. Wow, we've never seen that since the early 1950s, after World War II, whenever it was. So there was a lot of optimism. But if you look at it, that's a percent change from the basement. we're halfway up to the first floor. We're not back up to where we were before the beginning of the recession. We're still in a recession, and there's a lot more to do before we can say, okay, now we're into the economic recovery phase. So what we were saying is, yes, it's good to be optimistic. There's the vaccinations going on. The economy is starting to rebuild and reopen, albeit in an extremely spotty and uneven fashion. There are reasons to be optimistic, but there's no reason to be overly optimistic, which I think is the theme that we laid out for 2021 in our in the January precious metals advisory that we issued. I think we said, there's no reason to be overly optimistic.
Yeah, it's been a while since my last macroeconomics exam in school, Jeff, but correct me if I'm wrong. I thought that a recession is just simply defined as 2 consecutive quarters of GDP contraction, and we're over that.
Mm-hmm. It's up to the National Bureau of Economic Research to decide, and usually they don't. They mark the end of a recession at the point where you get back to the previous peak output level.
Okay.
You're thinking of what defines the onset of a recession. And what defines the onset of a recession is 2 consecutive periods of negative contraction in real economic activity. Then you're in if you only have 1 quarter of contraction, it's not a recession. You need 2 quarters. Now you're in a recession. Then the question is, when do you get out of the recession?
Yes.
And the answer is when you get back to where you were before the recession started.
Okay. All right. Well, I guess, I don't know, some people might just look at it as semantics, but if you're looking at the real economy, if you're looking at things opening up and consumer spending, what's your sentiment right now? Are you satisfied as not just an investor, but maybe just a citizen of the world with how the economy is recovering?
I think that we're doing well. I think we could be doing a little bit better. I think that there are still enormous problems that are not being dealt with either on a national government level or a state government level or a corporate level. And I think that there continues to be a tremendous breakdown in international cooperation, which is really needed to help coordinate and sustain the economic recovery out of the recession and going forward. So I am somewhat optimistic, but I'm very realistic about the pace of it in the face of all of those issues like sovereign debt and deficit spending and political divisions that remain unresolved and in some cases exacerbated.
Okay, finally, Jeff, let's talk about your Silver Yearbook. That's coming out. What is that exactly, and what should we be looking out for?
The Silver Yearbook will be released in next week, next Tuesday, the 11th of May, 10 o'clock until about 11:30 Eastern Daylight Time. We'll have a internet briefing followed by a Q&A period. It's open to anybody who wants to. You can, I think, go to cpmgroup.com. Or you can send an email to info@cpmgroup.com and register for it. I think we have space for about 3,000 people to listen in. We've been producing annual silver reviews and outlooks or statistics and analysis reports really since the 70s. They predate my time at J. Aron in the research department, but it went from the J. Aron research department to Goldman to CPM Group. So these things have been around for about 50 years. And they are really the definitive work on silver supply, demand, investment demand, and inventories. This year, we obviously talk a little bit about the silver squeeze boys and what they did in the market and the consequences of it. We also have expanded our discussion of historical inventories and including in doing that, we've also included a lot of information about the history of the silver markets really since 1950, 1940, and the history of silver market research. And we did that as part of this program that we have to memorialize some of the history that we have and the data that we have that is not necessarily available anywhere else in the markets. So the Silver Yearbook next Tuesday, 10 a.m. On the internet, 10 a.m. Eastern Time, open to anybody who wants to register for it.
Okay.
And, it'll be like 45 minutes of presentation of the conclusions.
Great. And we'll put the link in the description. Thank you, Jeff.
You're welcome. It's always a pleasure to be with you.
Always a pleasure. My pleasure is all mine. And thank you for watching Kitco News. I'm David Lin. Stay tuned for more.